Welcome to Drill Down Earnings. I'm Cory Johnson, Chief Market Strategist of Epistrophy Capital Research. And Comfort Systems, this HVAC electrical repair company, I think it's one of the 50 most important companies in technology. It's what we focus on right here. Now, I'm biased on this. I've owned this stock for most of a decade, and it's maybe the best investment I've ever invested in, been lucky to stumble into. This is not investment advice, but I think it's a really important technology story. So let's talk about it. So company reported second quarter earnings, crushed the estimates on Wall Street, beat my estimates in certain parts of this business. Just a fantastic quarter. Their fantastic revenues in the quarter, up over $2 billion for the first time in company history. Fantastic profits, $231 million in net income in the quarter. 20% top line revenue growth, specifically $2.17 billion in revenue, up 20%. Just fantastic profits, earnings per share up 75% on a year-over-year basis. So really impressive. Now, what is this company? So when I invested in this 7 or 8 years ago, and I had owned it many years before that for a little while too, I was intrigued that an HVAC and eventually an electrical company that was a serial acquirer could be a good business. These seem like sleepy businesses, right? HVAC and HVAC, whatever you want to call it, and electrical seems kind of sleepy. And serial acquirers rarely do well. Few companies are able to do that successfully. But these guys have bought lots of mom and pop shops, if you can call that, companies doing 10, 20, $30 million in revenues, figured out how to put them into their own system and add to their business, as well as follow the hottest trends in building. They don't care what's being built. They want to build what needs to be built, and they're very good at it. And what needs to be built right now? Data centers. So let's talk about this. So their electrical segment up 49%. It's the smaller of their two big businesses. Mechanical up 13% on a year-over-year basis. Again, strong industrial growth, strong tech infrastructure growth, data centers, and indeed 63% of the revenues came from industrial projects, 40% of those technology clients. So as their business has grown, their profit margins have gotten better, 14% margins, the best I can remember ever for this company. What do? I'm going to take a breath. Maybe I should take a drink before I do this because I swear this is water, not tequila. But look, technology, manufacturing, education, healthcare, office building, retail, restaurants, entertainment, government, multifamily, residential, and other stuff. But 43% of the revenues right now are technology. And technology was a non-existent business for these guys 5 years ago. It's been growing fantastically, 66% over what it was a year ago, and it was the biggest it had ever been a year ago. So these guys growing where the business is needed. While manufacturing was actually down 10% on a year-over-year basis, it's still a very big part of their business. Even their healthcare business growing. Healthcare was 9% of revenues, but it's growing at 38% on a year-over-year basis. So really fast growth, really profitable growth. A big change in their growth is they're doing a lot more modular work. They're not just sending out guys in trucks with raw materials to figure out what needs to be built, but they're doing some modular construction to make these things happen faster. It's now 18% of revenues with 2.7 million square feet of dedicated capacity and expansion. They think they'll be at 3 million square feet with them able to build out these modular units and then ship them largely already built or at least partially built to the sites. Just fantastic growth there. And it's really the hyperscalers that want this stuff showing up, nearly built. They're building as fast as they can. Their service revenues also at 10%, now 15% of revenues for this company, and still doing acquisitions. They announced the acquisition of Florida-based Right Way Plumbing, which is going to add about $65 million in expected annual revenues. They're also doing share buybacks. They're paying out dividends to shareholders like me. Thank you very much, Comfort Systems. And they've also got a ton of cash. So really interesting. But the story really is about technology breaking away for this company. It's still doing, like I said, 66% growth, growing better than any of their other industrial segments and coming to dominate this business at Comfort Systems. How did the market react? The market went straight up. I fainted. I didn't really faint, but it was kind of amazing to see, one of my biggest investments of 22% when the day starts, and held up strong all day long. Look at the 1 year stock chart up 136% in 1 year. And importantly, the orders are still coming in. Their backlog is now up to $8.1 billion, up 41% on a year-over-year basis. And the book to bill, so if you look at the trailing 12 months of revenues compared to what they've got for billings going forward, is now 1.06. That's about as high as it's been. And though it's not insane, right? If it was 3 or 4 times, you wonder, are customers going to cancel? Can they manage to fulfill all these orders? Book-to-bill at 1.06 is nowhere near a record for this business. It's right in line with their kind of peaks. They're ready to do this business, and the business is coming in the door. And tech, says the CEO, even though the company's based in Houston, yes, he's got a Boston accent. The CEO tells us that technology is what is driving this business. It is red hot.
Obviously, tech is, red hot right now. So we're trying to service those customers the best we can. But we are keeping our fingers in all the pies. Everything but commercial, right? Office buildings is slow. Everything else has got good activity. And I think they're selecting, I think we're, the best working conditions for our people. They're going to pay for the risk and the service we provide.
So that red hot tech business growing by leaps and bounds, and Comfort System is ready. But what's it all mean if you want to think of the big drill down earnings takeaway, the one number that means a whole lot? Well, Comfort Systems USA Q2 earnings, a strong quarter from a stock that's up over 140%. It has outperformed Nvidia over the last 5 and 10 years in terms of total return. Just fantastic. And I'm fully biased because I own this stock. It's not investment advice, but I am giddy with the success of this company. 20% revenue growth on a year-over-year basis. Their technology sector, which wasn't even part of their business years ago, now 66% revenue growth in their biggest business here. But I think the most important number, the drill down earnings bite, the one number that tells you a whole lot, is $8,123,708,000. That is the backlog for Comfort Systems. It's larger than their revenues in the last 1.06, so 106% times of revenues over the last 12 months. The business is growing, the backlog is growing, and it's great signs for Comfort Systems. Yes, a stock that I own. Pretty happy about that right now. All right, thanks for checking out Drill Down Earnings. Follow us. I'm on X at Cory TV, and you can follow all of our Epistrophy Capital Research research summaries on TikTok, on Instagram, and on YouTube at Drill Down Pod.